Thanks for joining us today. You've tuned into Business Daily, and I'm Lee Ji-yoon in Seoul. Before we get started, let's first get a quick check of today's highlights. Next year's budget looks to be bigger than this year's. The government hopes injecting more money will help boost the Korean economy. But what about its fiscal deficit? With the potential U.S. rate hike in the works and many currencies around the world at record lows, are we expecting a fierce currency war? We sit down with an expert to talk about this. But first, the Finance Ministry has laid out the government's budget proposal for next year. It'll be 3% higher than this year's, as officials hope to fire up the sluggish economy. But at the same time, there are growing concerns over its fiscal deficit that's headed for a 7-year high. Our Shin Se-min starts us off.
The Korean government has laid out a moderate spending plan for 2016 as it aims to prop up the economy while maintaining an expansionary fiscal policy. In its new budget proposal, the Finance Ministry said the government will raise spending by 3% from this year to 386.7 trillion won, or 320 billion US dollars. That's an increase from this year's budget, including the supplementary package approved in July.
The government will do its part in firming up the domestic economy, and the higher level of national debt should be seen as an inevitable means to support the economy.
Nearly 32% will be spent on improving social welfare, with about 13% of that earmarked for youth employment. The government will also boost spending on defense by 4% as it aims to modernize military equipment in the face of possible North Korean threats. While the government has put much emphasis on improving its fiscal balance and says it'll narrow the deficit gap dramatically in the next 5 years, the problem is the growing level of government debt. Sovereign debt levels are expected to surpass 40% of the country's gross domestic product, the highest figure on record.
Although the country's fiscal deficit is at optimum levels compared to other OECD nations, it has full potential to reach worrying heights, as the country's aging population and the youth unemployment crisis will only push the government to spend more in the years to come.
The government said the country's fiscal deficit next year will widen to represent 2.3% of its GDP from 2.1% this year. But it remains confident that its level of spending will help improve fiscal balance by leading to more tax revenues. Shin Se-min, Business Daily.
Well, meanwhile, the Korean won is projected to drop further by the end of the year after dipping to a 5-year low against the U.S. dollar on Monday due to China market jitters and expectations of a U.S. rate hike. 31 global investment banks on Tuesday forecast the won to average 1,200 per dollar in the fourth quarter of this year. This is down 51 from last month's projections. Credit Suisse and HSBC anticipate a fall beyond 1,221. ABN AMRO and ANZ expect the worst, predicting 1,241 against a greenback. Next year, experts forecast even further weakening. Morgan Stanley and ABN AMRO predict that the won will tumble to 1,290 by the third quarter. We're now in the second week of September, but still no clear sign of whether the U.S. Federal Reserve will carry out a rate liftoff next week. And with uncertainties on the rise, fears also grow over the breakout of currency wars across the globe. Take a look.
Fears are on the rise that the global economy may be entering a new round of currency wars. Just last month, China surprised the world by depreciating its currency 3 days in a row, leading to the biggest drop in the yuan in more than 2 decades. With growing concerns that a weaker yuan will hurt countries exporting to China, currencies in emerging economies have also plunged. Experts say that such moves might be setting the stage for a full-blown currency war. This is as stimulus measures are already in place in Japan after Tokyo introduced Abenomics in 2012, and the European Central Bank also has been engaging in quantitative easing since early this year. Now all eyes are on whether the US Federal Reserve will pull the trigger on its first rate hike in nearly a decade, and what kind of impact it will have on the global currency front.
And to tell us more about this, Professor Yang Jun-seok from the Catholic University of Korea joins us in the studio today. So good to see you, Professor.
Happy to be here.
All right, so this currency war, some are saying that this war is in full flow and there's no sign of stopping. Following China's Yuan devaluations, emerging market currencies are also plunging. Now, what's the situation like in world economies and their currencies?
Okay, well, some of the countries that they're talking about, Vietnam has devalued its currency and then expanded its exchange rate band, the area that the rate can float from plus minus 1% to plus minus 2%. Kazakhstan has gone from a pegged fixed rate system to a free floating system. And then, well, the yuan, there was that big devaluation that they had in August,
right.
But it's recovered somewhat. So compared to the period before devaluation, they're down right now about 3%. The yen is an interesting story. Yen has been depreciating throughout the year, but ever since this instability came in, it's been strengthening.
Oh, actually strengthening,
yes.
Okay.
So right now, they're about the level that the yen was in January. Now, the most interesting story here may be Korea. Korea, if you compare it to January 1st, and it's always, this type of analysis really differs a lot depending on where you start the date. But compared to January 1st to yesterday, Korean won depreciated by about 10%.
10%?
So we're actually the highest in terms of depreciation of the currency.
All right, so we're at the center of the currency war, I guess. Well, but then another big factor is the U.S. Federal Reserve's possible rate hike, which might come next week. And now there are concerns that this might actually intensify currency wars across the world.
Right. I think what we're seeing here is basically a mini taper tantrum, that type of thing that we saw in 2013. And I'm not as confident as saying that the countries are depreciating or devaluing their currency because they want to improve their exports, but it seems a lot more like market forces at work. Now, I talked about Vietnam and Kazakhstan earlier. Those countries are actually putting their currencies more into the market rather than putting themselves out and trying to control the market because, well, they've expanded their floating band, and Kazakhstan actually allowed their currency to float. So it's actually going more in terms of the market rather than the government trying to control it. But apparently the market expects all this depreciation.
Well, looking at the big picture, how would all this affect the global economy if all these countries start to devalue their currencies?
Okay, well, if it's a natural force of the market and the anticipation of the Fed rise, then it's acceptable, I think. But if it's sort of a mini panic where they're moving towards safer currencies, then I think it's a big instability which leads to nothing. So it just adds to the chaos. I don't think it does any country any good at all. Now, if these countries are actually devaluing their currency to improve their exports, like a lot of countries were accusing Japan of doing for the last few years, then you would have a beggar thy neighbor policy, which is never good because, well, you're trying to improve your economy at the expense of other economies, as well known, and that leads to lower global growth overall. But right now, I'm not confident that the governments are lowering their currencies deliberately, especially for the emerging market economies. It seems more like market forces at work in anticipation of the Fed rate rise and the instability that followed it. We've seen same kind of patterns in taper tantrum of 2013.
But then past Saturday, the group of 20 nations met and they actually said that they should refrain from competitive devaluation. How do they expect to do that?
Okay, well, I think, again, if this is market forces, then they cannot really do much about it. But I think the popular perception, because of the Abenomics, because the Chinese exports have been falling, is that they're doing competitive devaluation to improve exports. This, I think, is not helped by the fact that the U.S. is undergoing presidential elections. And they tend to look at any type of devaluation or any type of things that can affect American exports as somewhat deliberate.
All right. Well, it almost seems like that it's a thing between the U.S. and China because the U.S. hasn't been really welcoming China's devaluation moves. And some experts are actually saying that this might lead to a trade conflict between the two countries.
Well, a lot of U.S. presidential candidates, especially on the Republican side, but some Democrats as well, seem to be taking up that kind of a battle cry. I think during elections in economically difficult years, you've seen American candidates do that a lot. Now, in terms of the actual economics, I think there was a very good case to be made that China was undervaluing its currency 1 or 2 years ago. But according to IMF calculations, which came out earlier this year, IMF does not believe that the Chinese yuan is undervalued, or at least at the time that the report came out in, I think, April.
All right. Well, let's come back to Korea. What should the Korean government do amid all these fierce currency battles? How should it prepare? What kind of countermeasures should it come up with?
Okay. Well, as I mentioned before, the won has been depreciated by about 10%. The most of that depreciation has come within the last few weeks. So we cannot really go around, I think, saying that we should depreciate even more because we're pretty much ahead of the pack.
Right.
But if this is indeed because of market forces, then I think that it's driven by the U.S. Fed possible interest rate rise, and it's driven by flight to safety. In that case, well, the government can't do much except monitor at the moment. Now, if the capital outflow and the depreciation is slow, then I think we should let it go on because it's the natural market adjustment. But if it accelerates a lot, then I think government should take decisive actions to try to limit the capital outflow, but that's an emergency measure. As long as the pattern is like what we see right now, which is slow and steady type of depreciation, capital outflow, then I think we should let it go on.
All right, so close monitoring would be the key for now.
Yes.
All right, thank you so much for your insight today, Professor.
Thank you.
News about China's cooling economy is nothing new to us now, but what is new is that analysts are saying the impact of slow growth in the world's second largest economy on countries dependent on its imports could be more serious than expected. In fact, latest data show that Korea will be the third hardest hit if demand from China continues to fall. Our Kwon So-ah is on the story for us today.
China's imports fell 13.8% in August in dollar terms from the same month last year. That's a huge drop from July and a big difference from experts' expectations. China's exports also experienced a 5.5% drop last month. And both figures are similar to what they've been in previous months. With China's trade figures continuing the downward trend, there are concerns that the already substantial impact on countries intimately tied to China could bring further dark clouds in their economic growth. China's imports were down 14.6% over the first 7 months of the year from the same period in the previous year. According to an analysis by The Guardian, if the level of decline stays the same for the rest of the year, New Zealand and Australia would be the countries hit the hardest. The GDP of New Zealand and Australia would drop by 1.9% and 1.7% respectively. And Korea, which exports around a quarter of its outbound shipments to China, would be the third most affected country, with a 1% decline in its GDP and a loss of almost $13.9 billion in exports. Although China imports the largest amount of goods from Korea, the proportion dropped by almost 1% from January to July. Experts say Korea will have to defend itself from more risks from China with new policy measures such as a cut to its key interest rate. Kwon So-ah, Business Daily.
Many Koreans have been taking out loans from commercial banks as the country's interest rates hover at record lows. But a growing number of people are turning to options outside of mainstream banks, leading to heavier payment burdens and mounting concerns. Our Lee Ju-young tells us more.
Korea's credit-based household loans that were extended by non-bank financial institutions from the April to June period have increased by $4.2 billion from the previous quarter. This growth marks an all-time high, putting the outstanding sum owed to non-bank institutions at $114 billion, roughly 12% of the nation's total household debt. Most mortgage loans issued by first-tier banks apply interest rates at less than 3.5%, while in contrast, the rates on second-tier loans range from 12 to 29%. But those in the lower income bracket are often left with no choice but to resort to loans from secondary financial institutions as major commercial banks turn down individuals with low credit scores or without collateral. Experts say concerns are escalating over the recent surge in non-bank loans and the possibility of seeing more loan delinquencies in the coming years. This comes especially as fears of a potential rate hike down the line are on the rise.
Low-income borrowers would be vulnerable if the key interest rate goes up, since many non-bank institutions have higher ratios of floating interest rates. So we need preemptive measures.
With more households turning to non-bank loans following the MERS outbreak that shook the country, market watchers warn, without such precautionary measures, this snowballing debt could create much larger problems for the economy down the line. Lee Ju-young, Business Daily.
And that brings us to the end. Hope you enjoyed it. We'll be back tomorrow at the same time, same place. As always, thank you for watching.